Hello, my name is Professor Abdul Qadir Arsiwala, and this is our first lecture on journal entries. Before we start on the complex problems of journal entries and gradually move towards the ledger entries, we shall begin our studies with the basic lecture and a simple problem on journal entries. The problem goes as follows. Let's just look at the problem first. Enter the following transactions in the journal of Seth and Sons. The transactions for a period of April, that is a month of April, has been given. 1st April started business with the cash of rupees 1 lakh. 3rd April goods purchased for rupees 25,000. 5th April machinery purchased from Suresh rupees 40,000. 8th April rent paid in cash rupees 12,000. 10th April goods purchased on credit from Subhash rupees 30,000. 13th April goods sold for cash rupees 60,000. 18th April goods sold on credit to Rahim rupees 40,000. 21st April salaries paid 16,000, and 25th April cash withdrawn for personal use rupees 5,000. So these are the problems, and we have to pass journal entries for all these transactions. So let us first draw the pro forma of the journal. See, the journal entry or a journal book should look like this. The heading should come journal entries in the books of Messrs. Seth and Sons. Then it should have, any journal should have 5 columns. The first column will be for the date at which the transaction is happening. Second should be the particulars column. Third should be the ledgers folio. Fourth, the debit amount, and fifth, the credit amount. Now let us start the problem. First is the April 1st started business with the cash of rupees 1 lakh. Now the two accounts which are coming under this entry are the capital account of business and the cash. Okay, so Mr. Seth and Sons have started their business with the cash of rupees 1 lakh. They have bought this cash into the business. Okay, so each and every transaction will have impact on two accounts. Here the two accounts are, one is the cash account and second is the capital account. Okay, so cash is coming in the business and capital is getting raised. Now cash is a real account. The rule for real account is debit what comes in, credit what goes out. Okay, and going by that rule, cash is coming inside the business, so the transaction will be, first of all we'll write the date, 1st April cash account debit rupees 1 lakhs to capital account rupees 1 lakh. Cash is coming inside the business, debit what comes in, hence cash account debit, and to capital account is being raised by rupees 1 lakh. The narration will be given as being cash brought in business rupees 1 lakhs. So this was the first adjustment. Next is the adjustment on 3rd April, that is goods purchased for cash at rupees 25,000. Again, here there are two accounts which have been affected. One is the cash account and second is the goods account. We are purchasing the goods. Okay, so one will be the purchases account and second will be the cash account. Now, whenever we purchase some goods, the goods come inside the business, okay, and cash goes out of the business. Both of them are real account. So, debit what comes in, purchases account will be debited, and credit what goes out, that is cash goes out. So, cash account will be credited, and the amount will be 25,000. So, again, I'll write down the date, 3rd April. Goods are being purchased, so purchases account will be debited by rupees 25,000, and cash account will be credited by rupees 25,000. Narration will be being goods purchased for cash. Okay, so that was our second transaction. Third is 5th April, machinery purchased from Suresh. Again, here we are purchasing something, but we are not purchasing goods, so we won't term it as a purchases. We are purchasing machinery. Okay, machinery is a real account, it is an asset. Okay, and the second account is that we are purchasing the machinery from Mr. Suresh. Here it is not given that machinery is purchased for cash or credit, but the name of the party from whom we are purchasing, that is Mr. Suresh, is given. So kindly remember, whenever such an adjustment comes, it always means that the machinery has been purchased on credit. Okay, whenever the name of the party comes in the problem, you will assume that the purchases of machinery or goods or whatever have been made in credit. Okay, so the two accounts which come into play are Mr. Suresh's account and machinery account. Now, machinery account is a real account. The rule for real account states that debit what comes in, credit what goes out. And Mr. Suresh is a personal account. Okay, so rules for personal account are debit the receiver, credit the giver. Now, machinery is coming inside the business, and Mr. Suresh is giving the machinery on credit to us. Okay, the price for machinery is 40,000. So the final adjustment will be as follows. I'll write the date first. Machinery account debit rupees 40,000 to Suresh account rupees 40,000. Narration being machinery purchased on credit. Okay, so this was the third adjustment. Then next, rent paid in cash rupees 12,000. Now here we have paid the rent for the premises in cash rupees 12,000. Two accounts, that is, one is the cash account and second is the rent account. Both of them are cash is a real account which states that debit what comes in, credit what goes out, and rent is a nominal account. The rule for nominal accounts is debit all expenses and losses and credit all incomes and gains. So rent is an expense, so it will be debited, and cash is going out of the business, so it will be credited. So the entry will be, first of all, the date, that is 8th April. Rent account debit rupees 12,000 to cash account rupees 12,000. Narration will be being rent paid. Okay, here The fourth adjustment is also complete. Next, goods purchased on credit from Mr. Subhash, rupees 30,000. Again, here we have made some purchases, but instead of purchasing on cash, we have purchased on credit from Mr. Subhash. So the two accounts, one will be the purchases account and second will be Mr. Subhash's account. Purchases account is a real account which states that debit what comes in, credit what goes out. Goods are coming in, purchase account will be debited. And Subhash is a personal account which states that debit the receiver, credit the giver. Mr. Subhash is giving us the goods of rupees 30,000 on credit. So Mr. Subhash's account will be credited here. The final adjustment for this problem will be 10th April. Purchases account debit. The amount is rupees 30,000 to Subhash account rupees 30,000 being goods purchased on credit. Okay, so that was the fifth entry. The sixth entry is goods sold for cash rupees 60,000. The two accounts which come into play are the goods account, that is the sales, and cash. Okay, cash account is a real account. Debit what comes in, credit what goes out. Cash is coming inside the business, so it will be debited. Goods are going outside, goods are being sold, so they will be credited as sales. The entry will be, first of all, the date 13th April. Cash account, since the goods are being sold for cash, cash account, the amount is 60,000 rupees, 60,000 to sales account rupees 60,000 being goods sold for cash. That's the sixth adjustment. Cash accounts debit to sales account rupees 60,000. Next, goods sold on credit to Rahim for 40,000. Again, these are the sales, but instead of selling on cash, we have sold on credit to Mr. Rahim. Here, Mr. Rahim is a personal account, and the rule of personal account is debit the receiver, credit the giver. Mr. Rahim is receiving the goods of rupees 40,000 which we are selling. Goods are moving out of our business, so goods account will be credited. The entry will go as follows. First of all, there will be a date, that is 18th April. Who is receiving the goods? Mr. Rahim. So Rahim account debit, the amount is 40,000 to sales account 40,000 being goods sold on credit. That's the seventh adjustment. Next, salaries paid rupees 16,000. Now, salaries have been paid. Salaries are always paid in cash. So, two accounts here are, one is the salary and second is the cash. Salary is a nominal account. The rule for nominal account is debit all expenses and losses, credit all incomes and gains. And cash is a real account which states that debit what comes in, credit what goes out. So cash is going out, cash will be credited. Salary is an expense, salary will be debited. So the adjustment will be 21st April salary account debit. The amount was 16,000 rupees to cash account 16,000 being goods sold, not being goods sold, being salary paid in cash. Now let's move on to our final adjustment, cash withdrawn for personal use. Okay, so we have withdrawn some cash for our personal use. Such withdrawal is called drawings. Okay, drawings happen from the our capital account, that is we are reducing our capital, and we are reducing our capital account, we are taking out cash from our businesses. Okay, so two accounts will be, one will be the drawing account and second will be the cash account. Now cash account is the real account which states that debit what comes in, credit what goes out. Since cash is going out of the business, we are withdrawing the cash from the business for our personal use. Cash account will be credited, and since cash account is being credited, naturally the drawings account, that is the goods, the cash which we are withdrawing for our personal use, drawings account will be debited. So the adjustment will be 25th April drawings account debited by rupees 5,000 to cash account credited by rupees 5,000 being cash withdrawn for personal use. Okay, so this brings us to the end of our problem number 1. All the 9 adjustments have been taken care of. Just take the total of the debit side and the total of the credit side. If it comes the same, then you have solved the problem correctly. Okay, that's it. Thank you.